Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Goulden, senior research analyst with Cumberland DRW, to discuss the upcoming Ethereum merge. It is great to see you, Stephen. Welcome to Trade Talks.
Thank you for having me.
How is the market positioned going into the merge?
Yeah, so I mean, clearly this has been fairly well anticipated, right? And I think by now, most institutions and probably retail traders understand the main implications. And you can see that in terms of, things like the ETH BTC cross, which is up around 50% since the June lows. Some of that's been unwinding the last week. And obviously today we saw a little bit of a sell-off post CPI. But clearly, this is fairly well understood. I mean, for a bit of background, ETH will also fork post the merge, and some holders, I think, are long spot in anticipation of that and selling futures to kind of hedge. So that's been, and that you've also seen some borrowing of ETH and selling of staked ETH in some of the decentralized exchanges. But in general, we're not seeing signs of excessive spot positioning and excessive longs going into the merge. And you can see that in terms of market technicals like on balance volume.
How will the new supply demand dynamic impact pricing both in the short and long term?
Yeah, so the key thing is that inflation, or kind of gross issuance of Ethereum, will drop by about 90%. But the other thing to remember is that under proof of work, miners sell about 70–80%, we think, which obviously goes towards covering their costs. Now, validators in proof of stake won't need to sell anything like that. And therefore, we think that the effective supply reduction will probably be over about 95%. Now, on the demand side, demand comes from gas, staking, and speculative demand, basically. Gas is very weak right now because of weak on-chain activity. Difficult to forecast how that may change. Staking is around 11% of Ethereum, which is very low compared to other L1s. We would expect some catch up in staking, and people have been put off because of the proof of work fork, and also I think general technical concerns. So we'd expect that to be picking up a little bit. And then obviously speculative demand is hard to forecast. In bull markets, that can be up to 2 million tokens a month. We think that's obviously very unlikely given the macro situation, but factoring out speculative demand, I'd say you go from slight oversupply to maybe like 300,000–400,000 ETH per month supply deficit, basically.
Will the ETH proof of work gain any traction in the long term?
It's difficult to say. I think we'd be surprised if it gains material traction. And I think, a key part of that is the fact that the main DeFi protocols have come out in support of the proof of stake chain. So, but you may have some projects building on there. Clearly, it has support from the mining pools, and so on that basis, perhaps it has some kind of residual demand. But our underlying case is that most of the activity will very much be on proof of stake.
In terms of post-merge improvements and costs and transactions, what does that mean for the layer twos?
Yeah, so after the merge, so the merge itself won't really make much impact on gas costs or throughput. But post the merge, you have what's called the surge, which is essentially what will first be what's called proto-danksharding, which essentially means that layer twos like Polygon or Arbitrum can make larger and cheaper call data transactions, basically with the layer one. This means lower costs and far higher throughput. So and then following on from proto-danksharding, then you have full danksharding. This may take some years. It's uncertain at this point, but ultimately, we're pushing toward the long-term vision of 100,000 transactions per second or more. This is obviously great for L2s because the L2s are a critical part of that kind of scaling vision. And essentially what it means is, much lower transaction costs. It's much easier for applications to build on them. And clearly for the kind of leading L2s, the future is looking fairly bright, we think.
Stephen, going beyond the merge, what other major infrastructure projects in the crypto space is Cumberland following?
Yeah, sure. So, I mean, just within the L2 space there, I think that Polygon is looking kind of interesting. They are one of the leading L2 players. They have a number of solutions coming out likely next year. They are very much on the front foot from a business development perspective. And in fact, yesterday announced a partnership with Starbucks. And this comes on the back of a number of high profile partnerships with the likes of Disney and Instagram. So that's certainly a very interesting project right now. In the L1 space, Solana, I think, is looking very interesting as well. Solana's had a number of technical issues over the last year or so, but they're making some pretty dramatic changes to address them. Those technical issues have really been the kind of main bear case for the name. Clearly, that's being addressed, and we're seeing decent traction in terms of developer mindshare, project pipeline, and also VC activity. And I think if any of the major alternative L1s are going to be serious competitors to Ethereum, I think it's going to be Solana.
And finally, what about Web3 more broadly? What do you think the future of that looks like?
Yeah, so I think we think that one of the major narratives for the next cycle will be essentially real world businesses on crypto rails. And I think we're already starting to see some early traction there from some of the first movers. Until now, these applications haven't really had the infrastructure. Gas prices have been too high, and frankly, these things have been hard and take time to build, especially when you're competing with established Web2 incumbents. But we think that there's a clear kind of value case to building on crypto rails. The most obvious really are that you have kind of lower costs. You can automate a lot of your processes and outsource the infrastructure. But you can also use your token almost as kind of like non-cash marketing spend to bootstrap growth. And as many of these businesses are kind of like platform businesses, they have what is known as the cold start problem, and therefore can use this token to bootstrap early users and kind of platform liquidity. So, we think we're going to see a lot more of these businesses coming through. I think as you do, crypto really kind of proves itself and its reason to exist. And we think that's going to be a pretty strong narrative for the next cycle.
All right, Stephen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.